Welcome to Westminster College Center for Financial Wellness. This lesson is the second half of the review of transactions and financial statements. We will be reviewing how the transactions you entered in the balance sheet equation created financial statements, and then talk about the general purpose of each financial statement. As we learned in earlier courses, there are four main financial statements. The purpose of these financial statements is to communicate the results of operations and the financial status of a company based on the transactions that the company participated in. The four financial statements are based on the same transactions, but each financial statement focuses on a different aspect of those transactions. In other words, each financial statement is geared towards answering specific questions about the results of running the business. And here I have listed some examples of some possible questions. Here's our four financial statements. We have focused mostly on the balance sheet and the income statement in our analysis lessons, and now we'll look at all of them, including cash flow and statement of stockholders' equity. From your balance sheet equation transactions, the last worksheet in your workbook contains the results of all the financial statements. I'll flip over to that workbook right now. So you should have a worksheet that looks something like this. All right, we're going to go through each of the financial statements one at a time. If yours is a little different, don't worry. But if it's significantly different, you may want to review the transactions you entered and make sure that those that are not highlighted green, you might want to review and see if you can fix those. All right, so here's CSI's 3-year income statement. This financial statement has the main income statement elements, revenues and expenses. And we remember that revenue minus expenses equals our net income. All right, at the top of this financial statement, we can see that they have sales and then cost of goods sold, and then the net of those two is the gross income. So that tells us that this is a product-based company, at least in 2024. It looks like in prior years, they only did services because there's some services revenue down here, and they've continued that in 2024. What else can we look at? So their basic operating expenses, you recognize that when we did the analysis, we just generically put everything into expense. The financial statements will provide a little more detail like they've done here to differentiate the type of expenses. So salaries versus lease expense versus depreciation. But it's the same information. Our revenues minus our expenses are going to give us our net income. Looks like the only thing I'm missing on this that would make it more realistic is tax expense. Should have put that on there, but we didn't. All right. The statement of stockholders' equity focuses on the changes to the equity claims, which are shown in the balance sheet. Okay. The two types of equity claims are contributed capital and earned capital. So contributed capital, that's where people are contributing money and buying into the dream of the company. So they're buying stock. So that would be shown in this common stock area right here. Okay. The earned capital is shown in the retained earnings area. So here we have our retained earnings down in this area. Okay, we've talked a lot about the fact that earned capital comes from running the company. And so it's closely related to net income. And as a matter of fact, we can see that net income is part of the change to retained earnings. We can see that it's taken in 2024, we've gone from $9,950 in beginning retained earnings down to $19,950, and that's due to net income of $10,000. So that shows us our basic changes to our earned capital and our contributed capital. We'll see these balances on the balance sheet in just a second. Okay, so here's our balance sheet. It's our favorite one. This financial statement provides information about the stuff of value, the assets that the company owns or has rights to use. Also shown are the external claims, the liabilities, and the internal claims, the equity. The amounts shown in the common stock and the retained earnings accounts came from that statement of stockholders' equity that we just looked at. So you might recognize these balances right here, the 13,500 and the 19,950 that we just talked about. Okay, remember that this financial statement is basically just a pretty balance sheet equation. The equation assets equals liabilities plus equity must be true on the balance sheet. So here's my total assets, here's my total claims. That needs to be balanced. This is the cash flow statement. Okay, because cash is such an important asset, analysts and investors like to know where cash is spent and where it comes from. All transactions that impact cash are included in one of three categories: operating, investing, or financing. Okay, operating relates to activities involved in running the main business, so mowing lawns, buying gas, paying salaries. Investing relates to buying and selling long-term operational assets, so buying a lawnmower, buying computers, buying investments, or selling lawnmowers that you're not using anymore, things like that. Financing relates to interactions with owners and creditors, so getting loans, issuing a bond, paying dividends, issuing stock, paying back a loan principal. You can tell a lot about a company, what they've been up to, by reviewing their net cash flow from each of these three areas. So in our little company, in 2024, they actually had a negative cash flow from their operations. That's not unusual. It's actually part of the reason why we do accrual accounting. I won't go into why, but so they had a negative cash flow from their operating. Haven't done any investing activities other than their first year where they bought some office furniture, and looks pretty standard. In the early years, they had people contributing capital, or they got bank loans to start the company, and that trickled down. And they actually, in 2024, they just paid some on their dividend, on their loan. So that is the cash flow. This ending cash should balance with what we're going to see, what we saw in the balance sheet. Let's take a quick look. Yep, there it is, cash. There it is again. Okay. This slide provides a visual reminder of how the four financial statements relate to one another. Not only are these financial statements based on the same transactions, but some of the data is actually shared between the financial statements. So that's what the little arrows are for. One of those sets of arrows shows how net income goes from the income statement to the statement of stockholders' equity, and then from the balance in the retained earnings, which it is part of, up into the balance sheet. It's just to remind us that our financial statements are related. Together, they tell the whole story. One individual one doesn't quite tell us everything that we need to know. Let's take a look at a real business. It's a set of financial statements. We'll look at Harley-Davidson here. This is their income statement, and we can see from the revenue accounts that Harley-Davidson sells, it looks like, both services and motorcycles, so products, so services and products. Okay. There's a cost of goods sold account, and they've chosen to put it down with the rest of their operating expenses rather than showing it with the product sales and then calculating gross profit. That's fine. But we still have our revenues minus all of our expenses and some more expenses give us our net income. So the basic structure is still there. And it's kind of funny, you can kind of tell a lot about how a company internally sees itself by how it presents its financial information. For example, here, financial services revenue is actually, looks like less than 20% of their total revenue, and yet they still choose to show it separated out. So that kind of tells me they probably separately manage that, and that has something to do with their structure of Harley-Davidson, selling the products versus selling the financial services. So just kind of something interesting. Here's a statement of stockholders' equity. It's a lot to look at, yes, but we can look at the basics and understand what's going on here. Okay, these first three columns under common stock and then additional paid-in capital, these are all the equity that has been contributed. So this is them selling stock to stockholders. We can see the changes over the last 4 years. The way this works is it showing the beginning and then the ending for 1 year and the beginning and the ending for the next year, and so on. So the actual progress is going down each column. It looks like they've been issuing common stock, but it's been for purposes of compensation to their employees. So that's been their reason they've been increasing their common stock. Interesting. All right, so retained earnings. Next one I'm going to highlight. You know what retained earnings is. This is their earned capital. So this column will show the changes for the last 3 years that have happened to retained earnings. And so we would expect to see net income in here. And we do. So here's the net income for that year. We see that the net income has increased retained earnings for the 3 years. And then they also have some dividends that they paid out. So that's, we can understand this, even though it looks a little spooky looking at it at first, we actually can tell a lot about it. We understand how this is put together and what it's providing for us. We didn't go into accumulated other comprehensive income or treasury stock, and it's beyond this class. Perhaps you'll get to go over that in the next. Here's Harley-Davidson's balance sheet. Okay, so we've got assets listed, and I'm going to explain something here that we haven't so far. These assets are listed in order of liquidity. That means the assets that are going to be converted to cash the quickest are shown first. And those that take a little longer to be converted will be shown later. So this section right here is all of their current, what we call current assets. These are assets that will be converted to cash within a year. This list of assets down here is their long-term assets, and those would be obviously converted in a period of time greater than a year. So that's a common structural or formatting convention for balance sheets to show the assets in liquidity order. You'll notice that liabilities are the same thing. We've got current liabilities, but the logic here is these are the liabilities that we have to pay within a year. And then it looks like they've got some long-term liabilities sitting here that they'll pay, it'll take them longer than a year to pay. All right, so our equity section starts right here. Okay, remember the major categories in equity is contributed and earned. The long-term and current doesn't make sense in equity. So our contributed capital is shown by these stock accounts right here in the paid-in capital. And then our retained earnings would indicate the amounts of capital that we've earned. And we know that the balances in those came from our statement of stockholders' equity. Finally, here's their cash flow. It's another busy financial statement, but it still has the 3 major cash flow areas. Let's see, for operating, we show that they increased their cash by almost $2 billion from the operating activities. So selling motorcycles and providing financial services, that's netted them $1.2 billion increase in cash. So for our investing, looks like they have decreased about $66 million. All right, so that means that they bought more assets, long-term assets, than they sold during that period. And then finally in their financing, right here, it looks like they increased by $1.4 billion. So they relied quite a bit, it looks like, on owners or creditors to increase their cash. And it looks like it's from creditors, because here's a note payable, and here's some securitization debt. So they relied on debt. And that's kind of an interesting trend. You guys will get to analyze this kind of stuff in your next lessons. So what's interesting here is that Harley-Davidson doesn't even provide the detail behind the net operating cash flow, if you'll notice. They just give us the balance. And that's because this is included in their notes to their financials. Notice that right there. All right, what are notes to financials? The notes to the financials are the narrative information that's included with the financials. So if you have 4 pages of reports, an income statement, balance sheet, etc., you can have like 50 pages of narrative information and detailed schedules that provide more information about those financial statements. That's a lot of information, but a complete set of financial statements includes not just the reports, but those 50 odd pages of, not just the reports, but the 50 odd pages of notes included with it. So notice here's the income statement again. I didn't mention it, but notice this little annotation down here. The accompanying notes are integral to the consolidated financial statements. That's referring to that 50 plus pages of notes. So there's a lot of information available to you when you want to analyze financial statements. We've just done the basics of understanding how they even create the financial statements. But if you take the financial statements, the 50 pages plus the reports, and then you add it into the 10K, you're going to have around 200 pages worth of information. A 10K is the annual report required by the SEC that all publicly traded companies must file. All right, that concludes our review of analyzing with the balance sheet equation and revisiting the financial statements. And this is the end of the series of lessons, so congratulations. Go ahead and complete the related assignment, and good luck in your continued studies.